614 times 7%. It's going to be 6763. Which is 763. So we've got 96,614 plus 763 is 97,377. Always make sure this number is going up toward its face amount. So the very, very last year, when all is said and done, it'll be 100,000. Okay. So what's going to happen is, as this number goes up, so is your interest, because you're actually getting closer to the face amount. So your interest expense is going up a little bit more each year. Your cash is always staying the same. And that also means that you'd have 763 less here. You still would be paying out 6,000 in cash, and your interest expense this year would be 6,763. So if you had an income statement that had enough detail, you would see under interest expense that number for that year. You would not see 6,000, you'd see that number, and on the statement of cash flow under cash for interest paid, you would see that number.
Well, that will be for the cumulative bonds that the company issued.
Right, it would be for all of them and not just one, okay? And then you continue that on, okay? So does that make sense? Yeah. Okay. Does that help? You got it now? Sam,
Well, I don't know about that, but that was a close.
How about you, Scott? Are you still with us, or you,
We got Scott.
Where'd he go?
Good night, sweet Scott.
What did you do? You're little now.
oh. That's so he could snore and eat and drink, and we never
Yeah.
know.
Happy St. Patty's Day, everyone.
Yeah, it looks it.
Okay. So that's bonds.
Bonds.
Next question.
What's the value of using both LIFO and FIFO?
Most companies, if they're using LIFO, would prefer to use LIFO for all their inventories because that's the tax advantage. However, if you've got a multinational company, most countries other than the United States do not allow you to use LIFO.
Most
Deb's
companies
here too.
don't.
All right.
What?
Yeah.
Can you hear us?
Oh, she's doing the homework.
Ah, okay.
All right, so what was that again?
Am I on mute?
No, Deb's got a lot of
Yeah.
specific
what
questions.
were we talking about there?
LIFO.
LIFO and FIFO. Most companies, if they're using LIFO, want to use it for everything, but LIFO is only allowed in the United States. So if you've got operations in any other country, you're going to be forced to use FIFO, whether you want to or not. LIFO record keeping can get rather cumbersome. Now with computers, it's a little bit easier these days, but there's a lot of stuff you have to track. And so a lot of companies will say, you know, it's not worth it for the little tiny stuff. So like, if I'm making washing machine motors, yes, I spent a summer in an internship in college at one of the GE plants counting washing machine motors. Okay, so they had screws, they had little wires, they had all sorts of little tiny parts. It wasn't worth their effort to track that based on LIFO because you're talking pennies and less than a penny for each one of those screws. It was easier for them to either use average cost or a quick LIFO or a quick FIFO. So that's the reason why you'd have a company that says, you know, most of their inventories are on one or the other, or 60% is on LIFO and 40% is on FIFO, or vice versa, because they can't quite get all their inventory there, either because it's just too small and it's not worth it, or they're in different countries. Okay.
Is that just historical that other countries?
The other countries used to allow it, and they've all taken it out. What the problem is in the United States is if you use LIFO for tax purposes, you have to use it for financial statement purposes. And so what's happened is when we keep trying to get rid of LIFO for financial purposes, everybody goes, no way, because then I have to get rid of it for tax purposes, and it has serious tax implications, and they're all like, forget it. So either tax law's gotta be pulled apart from financial reporting law, where you can do FIFO for books and LIFO for tax, kinda like we do accelerated for plant, property, equipment, and straight line and accelerated for two different methods. Or you're gonna have to grandfather everybody in and say, starting from this date, we're gonna start at zero, but anything you had before, you can't lose from a tax standpoint. And the lobbies are just too powerful at this point in time to do that. We're talking steel companies, we're talking pharmacies, we're talking a lot of companies that have significant lobbying power, so at this point in time, we've not been able to do it. So one of the big sticking points between international accounting standards and us is that LIFO inventory that the U.S. is just not willing to give up at this point in time. Yeah. Okay. Yeah.
What does it mean by assets held for sale and liabilities held for sale?
Yeah, an asset held for sale is basically any sort of, something that used to be like plant, property, equipment, or land that you're no longer using in production and you intend to sell, gets moved into basically the investment category. So liability that would be held for resale would mean that you have a liability that goes along with that asset. So in other words, if I bought property using a bank loan, and then I decide I don't need that property, I'm gonna sell that property, I would move both the asset to held for resale and the liability that's associated with that.
Okay.
What kind of controls are on that though? Because what if you don't sell it and it's off your books?
Yeah, if you don't sell it, I mean, the biggest thing is you can't take depreciation on it. And so most companies don't like to reclassify it into held for resale because they don't get to take depreciation once they move it into that category. They'd rather keep saying, well, we're really gonna use it for productive purposes, whether we want to or not, because then they can at least keep taking some sort of tax deduction
So
off of that.
the liability held for sale is the contra account to the asset held for sale?
It's
Or
not a
the
contract, they're
balance?
balancing.
Yeah, okay.
It's the note that goes along with that asset most of the time, okay?
Okay.
So if you think about buying land with a note,
The yin and yang?
yin and yang, yeah, it's basically saying, okay, if I'm gonna sell the land, I'm also gonna get rid of the note at the same time. So it's not really debt I'm expecting to pay off because I'm trying to sell it.
Can you do a simple indirect to direct conversion of,
Simple, indirect,
or is there no such thing as a simple?
Can you hear us?
Actually, before we move to
Can you
that,
hear us?
a quick question, sorry.
That's okay.
Yes, can you hear me?
Yeah, yeah.
Yeah, we can hear you. Yeah.
You said that on LIFO conversions, don't worry about the percentage, just worry about the number they give you, that will be the difference.
Yeah,
So like.
Don't worry about the
Well, when they
percentages.
have, LIFO, and they have FIFO, and they say, you know, this
percentage, right,
Yeah.
you don't need to worry about that.
Okay.
Because the idea is, if your ending inventory is a mixture of both LIFO and FIFO, and they're telling you of the ending inventory, this